In this lesson, I'm going to go over the different types of trades. There are many, many different types of trades, and I'm going to go over the most popular ones. And if you can understand these, you can understand any of the types of trades that are out there. Pretty much every type of option strategy involves a spread. So what is a spread? Well, they're the basic building blocks of many options trading strategies. A spread position is entered into by buying and selling an equal number of options of the same class on the same underlying, but with different strike prices or expiration dates. The three main classes of spreads are horizontal spreads, vertical spreads, and diagonal spreads. They're grouped by relationships between strike price and expiration dates of the options involved. A vertical spread, or money spreads, are spreads involving options of the same underlying security, same expiration month, but at different strike prices. A horizontal spread, or calendar spreads, or time spreads, are created using options of the same underlying security, the same strike prices, but different expiration dates. And third, the diagonal spread is constructed using options of the same underlying security, but different strike prices and different expiration dates. They're called diagonal spreads because they're a combination of a vertical and horizontal spread. So let's take a look at a horizontal spread on the QQQ. Let's say that we sell the 110 call and we purchase the 112 call, and we'll look at this, analyze this trade. Now, when I sold the 110 call, that means I pretty much got short because I sold premium, and I want this to go down in order to be profitable. But I did purchase the 112 to limit my risk. So this is a short position where I sold premium. It's a horizontal spread. Let's look at a calendar spread. A calendar spread would be, for example, buying, let's just say this 112 call with 45 days. And let's say that we sell the 112 call with 17 days. It's the same strike price and same call strikes. Let's analyze this. Basically here with a calendar spread, we bought one and sold the other. We're pinning a strike. We want this to end at 112. And you can see that it's a neutral strategy. But we want this one that we're short, we want it to roll off. We want it to expire worthless, and we still want to hold this other 112 call with more time. We want it to be worth more than 72 cents. Depending on where the underlying goes, at expiration, it will be worth more than 72 cents. Or if the underlying goes away from the 112, you can lose money either way, in either direction. Let's look at a diagonal spread. There's a lot of different types of diagonal spreads. So we can go back to the 45 day. Let's say that we buy the 112 call. Let's go back and say we sell the 114 call. So now, not only are these different months or different expiration cycles, they're different strikes. Let's take a look at this trade. So you can see that this trade is long. So that would be considered a horizontal spread. Now, there's different types of horizontal spreads. There's credit spreads and there's debit spreads. Let's talk about a credit spread. A credit spread would be if you sell something, let's say this 110 call, and you buy something that's worth less. Let's say this costs what? 209. So if I buy something worth less than 209, say I buy this 112, that would be a credit spread because I'm going to receive a credit when I place that trade. So what's a debit spread? Well, it could be the opposite. If I were to buy something, like say this 110 call, and sell something worth less than that 215, let's say I was going to sell the 112. Now I'm actually going to pay a debit, that would be a debit spread, for that position. Now the difference between credit spreads and debit spreads, for the most part, is that a credit spread is not as directional as a debit spread. With a credit spread, you increase your break even. So if the underlying stays, let's say right now it's trading at 110.18. If the underlying stays at 110.18 in 45 days and you do a credit spread and it doesn't move at all, you're going to make money. But if you do a debit spread, you need this position to go your way. For example, see, this is the price of the underlying here. So it has to go higher for you to make money on a debit spread. It has to go that way. On a credit spread, just change these out. Here's the actual price of the underlying. If it doesn't move, you still make money. It doesn't have to go up. It can go down or stay the same on credit spreads. Now, this is a vertical spread. Well, what if I sold two vertical spreads? So what if I sold this 111 and bought the 112 on the call, let's say I sold the 109 and purchased the 108. Now I've got two credit spreads, one on either side. That's called an iron condor, and you can see what an iron condor looks like. You basically have picked a range that you want the stock to fall within. If it stays within 111.74 and 108.23 at expiration, you make money. If it goes beyond, you'll lose money, but your losses are capped. So what's a covered call? Well, covered call is if you were to buy the stock. So you buy a stock, let's put that in. And let's say that you sold a call, put that in there. So now you bought the stock and you sold the call. So you have no risk to the upside. See that? In fact, you want it to go up, but you do have risk to the downside. Now, if you did a covered put, it would be just the opposite. So if you sold short the stock and then you sold a put, let's make it a put that's out of the money. So there you go. You have downside risk, but no upside risk. That's called a covered put. Okay, what's a strangle? A strangle would be just selling an out of the money call. Let's say you sell this 112 call, and you also sell an out of the money put. So both of those. You've created a strangle. So a strangle looks like kind of similar to an iron condor, except it has unlimited risk. The risk is not capped. Your premium does decay a lot faster and you do take profits a lot quicker, but there is undefined risk. Now, what's a straddle? A straddle is the same thing we just did, but you do it at the money. So we're at 110.18. So 110 is at the money. So I'm going to sell that call at 110 and I'm going to sell the 110 put. You can take a look at what a straddle looks like. These are all neutral strategies and they're undefined risk. Now, okay, so what is an iron fly? Well, that would be selling the straddle, the at the money call and put, and then purchasing an out of the money put and purchasing an out of the money call to define that risk. See what that looks like. So you're basically pinning a strike here. You've got your break evens. Very similar to a straddle, except your risk is defined. Okay, what's an example of a butterfly? Butterfly is when you buy one, sell twice as many, and buy another. So, for example, you could buy this 110 call and say you sell the 112 twice as many, and that's $2 in width. So you want to buy the one that's $2 more. So you've bought one call, sold two calls, the 112 level, and then you purchased another one at the 114. So these are equidistant. See what a butterfly looks like. So a butterfly has a range and it has defined risk. Okay, let's talk about rolling. What I'm going to do is put in a credit spread. I'm going to sell the 110 and purchase the 112. Or let's see. We have this position on and time goes by. Right here, you can add time. Okay, so let's say we're at the very end and we decide we want to extend duration. We want to continue this trade. So what we can do is we can buy this position back and sell another one just like it, just further out in time. We can roll out. So for example, we can sell the 110, buy the 112. So what happens is we end up purchasing this one back. It's worth $1.01, this particular spread. And then we'll resell out this one for $1.06. So we actually collect 6 cents and we extend our duration. So we start with this and we end with pretty much the same thing. So we just extended our duration or we rolled out. That's called rolling. Let's talk about rolling in an iron condor. So let's go ahead and put on an iron condor. So we'll sell, let's say the 112 and we'll buy the 113 call spread, and we'll sell the 109 and buy the 108 put spread. What do we have? We have an iron condor. Now, what can happen? Well, the underlying can move up, down, or stay the same. Let's say that it moved up to 115. Remember I talked about rolling. So there's two things. If you wanted to roll, you could roll the put side, or you could roll the call side. These are two adjustments you can make. You can also close the position and take a loss. There's a lot of things you can do. But most professionals nowadays roll the untested side. Why did I call this one the put side, the untested side? Well, because remember, we were at 115 theoretically. This side got tested. The call side got tested.
We'll see you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieved my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.